Hello, everyone. It's Thursday, September 29th. Today on the Final Bar, I'm talking with Greg Schnell of Osprey Strategic. We'll talk about some of the areas of the market where he's potentially seeing some opportunity. It was a bull market for one day only. Today, right back to the bear phase, ladies and gentlemen. This is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down what happened in the markets using the language of technical analysis. Technical analysis is a set of tools to help you quantify investor behavior, understand market dynamics, and reflect the lessons of market history. And often my conversations with people like Greg Schnell and others, it's always, what does this remind you of, right? When have you seen this combination of things before? And in a lot of ways, 2022, pun intended, is uncharted territory, right? For a lot of us, we've not been in a rising rate environment. We've not been in a raging inflationary environment, not seen the Fed being as aggressive as they have, unwinding quantitative easing, which have been such a part of the markets in 2020 and 2021, and certainly before that. So in a lot of ways, we're left with the evidence that price reflects back to us. So let's look at what the markets are telling us. We have a great guest today, Greg Schnell. Greg is based up in the Calgary area, always does a great job helping us think about things like energy and materials. I always value my conversations with Greg. Coming up next week, a couple things to share with you. It is a special week because we have ChartCon coming up. So next Friday and Saturday, the 7th and 8th, will be ChartCon 2022. We will be doing a Final Bar episode on Monday and Tuesday. We'll be running it a little later at 6 p.m. Eastern because we have to record it. We'll be preparing our studio for ChartCon 2022, and I want to get you there. Greg Schnell is one of the many commentators. We're actually flying to our new studio in Redmond, Washington. We're going to be asking them how they navigate these markets and all the volatility that we've been experiencing with the VIX above 30 and all of that craziness. One of the segments Greg is involved with, which I'm really excited about, is the bulls versus bears debate. We have 4 charts. We will have a bull and a bear kind of breaking down the bullish and bearish argument for each of those different asset classes. It is going to be a lot of fun. I've talked with the panel. They've all graciously agreed to argue, in some cases, things they don't even agree with, but they will be highlighting how the evidence can reflect that perspective and give you the opportunity to think about different sides of the same coin. Go to stockcharts.com/chartcon to sign up for that fantastic event coming up next Friday. Let's continue on our show today with the market recap. Let's talk about what happened today. I introduced the show yesterday. Miss Schneider was on the show, and in my introduction, I said, welcome to the new bull market, because the S&P raging to the upside, but boy, it didn't feel like there was a great opportunity yet to celebrate. And today's sort of right back to earth. You have Apple down 4-5%. As I was looking going into the close, you had just under 5% to the downside. The S&P down about 2%. The NASDAQ down over 3% earlier in the day. So let's look at what happened. The S&P closing the day around 3640. The NASDAQ composite, as I mentioned, down almost 3%. Mid caps and small caps all around the same, right around over 2% to the downside. The VIX, which had come off a little bit, right back higher, just below 32. And, one of the things we've talked about recently, we'll have a segment a little later called Getting Sentimental, where we'll focus on sentiment readings. The AAII survey, by the way, one of the most negative readings in history, one of literally top 10 most bearish readings in recorded history, going back to 1987 today. So we'll look at that chart in a little while. I did want to mention the VIX, while getting above 30, remaining above 30 so far. And again, as long as it remains above 30, that tells you excessive volatility. That's more of an established down phase. When it gets back below 30, that's when we can start potentially celebrating or talking about the potential of a rally. We're not seeing it there yet. Looking at the bond markets, and there's an article, if you're a StockCharts member, which you, of course, absolutely should be, Martin Pring wrote an article for all of our members maybe a week and a half ago, talking about the relationship traditionally between bonds and stocks and commodities. If you miss it, I would strongly encourage you to look there, because a lot of the conversations I've had recently with Miss Schneider yesterday, with Samantha Leduc recently, talking all about the bond markets, right? Most of the conversation, when I asked Mark Chaikin, where should we look? He's bringing up bonds. And these are who people I would consider more equity-oriented investors are looking at the fixed income markets, which I think makes a ton of sense here. As long as rates remain elevated, as long as bonds remain in a downtrend, it's hard to imagine stocks mount a big, fantastic recovery. And today, while yesterday you saw a rally a bit in the bond markets, moving back down about 0.5%. The dollar index using the UUP down 0.4%, and obviously yields moving higher with the 10-year yield up to around 375. Gold finished the day about flat, although it chopped around quite a bit. Silver was down about 0.5%. Overall, commodities on the negative side, but worth noting that energy, one of the better, actually the best sector, essentially flat from yesterday's close when the market was down a couple percent. That's something to pay attention to. All sorts of interesting movements in cryptocurrencies, but at the end, not really mounting any sort of significant recovery. Bitcoin is sort of floundering, chopping around 19,400. Now it's chopping to the upside, overall netting up to a little more of a positive movement. As I mentioned, when Bitcoin gets above 20,000, you will hear me start to bring that chart up a little more and talk about a constructive inflection point and the potential for further upside. We're not there yet, and as a result, we'll continue ignoring it for now. Let's wait to see if there's some sort of bounce. Let's look at a chart of the S&P 500. And I look at this chart. It's one of the first charts I look at every day. But there's a lot happening on this chart. Today, we traded down lower than 36.36. That was the low, right around that level was the low from June of this year. And if you look, we're right there. And in the last week, we've essentially gapped down to that level of support, and we've chopped around there. Today, we traded lower, but closed almost exactly at that level. So we basically closed today at the June low. So I would argue, if you ask me, does this market feel more positive or negative? I would argue the evidence to me is still negative by the fact that breadth is negative, and breadth can be negative like this before much deeper declines. And just look back to 2008, 2009, if you want an example of what that might, potentially look like. Having said that, we're oversold right as we reach support levels. Bouncing yesterday was important. Semiconductors, Home Depot, all of these names bouncing beautifully. The NASDAQ composite still above its June low. All of that is really interesting data. So all that's encouraging. The problem I would have is we are about a tick away from closing below that June low. And when that does, I think you have to start looking at downside objectives that are much deeper than what we see now. Again, whether that's an unlikely scenario in your head, it's a possibility. And what I've learned as an investor is be open to possibility, be open-minded about where the market might head, and think about what a portfolio, what your holdings, what your signals might do given a future path for the S&P or a major market that you're looking at. So closing around 3640, we're still right at the June lows. I can't declare that level completely broken yet. But I would say on an intraday basis, we've gone through there. And I would argue the fact that we've gotten below 3,800, which is that first key Fibonacci level, helps me to think about downside potential. 3,200, I still think is the most likely eventual downside, but I can and have certainly been wrong at times in my career. We'll see what happens. In terms of sector movements, what actually played out today? Energy, the number one sector. I don't know how Greg Schnell, today's guest, somehow scripts the market. So when he comes on the show, energy is the obvious winner, but he pulled it off again. So energy flat for the day, which was pretty decent on a day when the S&P's down 2%, the NASDAQ down 3%. Healthcare was number two. And that's an interesting one because if you look at these next two sectors, healthcare and financials, talk about two sectors I would argue a lot of people have been ignoring. Financials have just had really ugly charts on average for quite some time. Healthcare has had a lot of really struggling charts in there. We had Biogen that gapped higher pretty quickly earlier in the week. A number of other names in that sector have actually started to improve to the point that it's worth noting. I was talking with Julius DeKempener earlier today, looking at some RRGs, and healthcare came up in a couple of those discussions as well. On the downside, utilities, consumer discretionary, real estate, technology. So a fascinating mix of the FANG sectors and some real defense like utilities and real estate. Now, those are more income plays, right? Those are more yield plays. And I would, arguably the interest rates on bonds keep going higher. The rate you'd get from a utility stock probably less and less, attractive. However, there are times certainly when the market struggled and utilities have been one of the better places. For what it's worth, down 4% today. Let's finish off looking at a couple individual names, and then we have to wrap it up. I did want to mention, where was I going to go here? DVN. DVN, when we talked about energy stocks, I'm struck that I've been asked, what do you own? And that's a standard question right now. If the market's so choppy, like where do you look right now? And arguably, I would say that in any environment, it's always a good time to own good charts. So focus on things that have good setups. And although it might be much less likely that they really play out beautifully, that you might expect in a bull market scenario, we saw from the first half in 2022, there are certainly times when the market, as defined by our growth-oriented benchmarks, can be very challenged, and certain areas of the market can actually be very strong enough to look at past DVN or FANG or any of the XLEN or the energy stocks to see how that could certainly be the case. What strikes me about DVN and a number of the other energy stocks, they've pulled back to key support levels. In DVN's case, pulling back to the 200-day moving average, which served as support in July and again in August. Now, once again, we're right back at that same level. So could DVN, roll over along with a lot of other things that rolled over on a day like today? Absolutely. Anything is possible. However, I would tend to give the benefit of the doubt to things that are testing support and rallying off of those levels. Up 1.5% today, while the markets were obviously sort of the same amount plus to the downside, and a decent yield on DVN, which is compelling to me as well. So charts like that are certainly of interest. What are some challenge charts? Apple, right? And when you think about the difficulty of our growth-oriented benchmarks to hold support, now worth noting, the Nasdaq has not broken its June low yet. It's actually holding above it. So that's something to certainly to watch going forward through the remainder of this week into next week. But some key names in that index are breaking down, and Apple's probably the biggest one. Apple and Microsoft, obviously the two biggest names in the technology sector. They're an outsized weight in the XLK. And Apple down pretty big today, almost 5%. So again, when you think about the FANG stocks, or what I call the phenomena stocks, why is it important to look at that key group of big mega cap names? Because if those names are struggling, it is really hard for our benchmarks to do well, even though areas of the market can actually do just fine. That's where I would argue some of the value-oriented parts of the market, that's where I'm looking for opportunities, because there is a scenario where the benchmarks struggle and those areas of the market actually hold up. Okay, let's take a quick commercial break. We'll come back with Greg Schnell of Osprey Strategic. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest, Greg Schnell. First off, we welcome your questions. We'll do a mailbag segment on Friday's show tomorrow this week. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions, hope to answer yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Great guest experts with a lot of knowledge and a lot of expertise to share, like Greg Schnell and many others, are featured on our Stock Charts on-demand platform. Greg particularly has been on the pitch. He was on our March Madness special called Chart Madness. We did a mock NFL draft together. There are a lot of things we've done actually through the course of this year. All of those things and much more available for free for you at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Greg Schnell. Greg's been a frequent guest on the Final Bar. It certainly appears on Stock Charts TV a good amount. Greg is the Chief Technical Strategist at Osprey Strategic. And Greg, it is awesome to see you. How are you?
I am really good. Thank you, Dave. Thanks for the invite.
Smiling, as I mentioned in the introduction. I somehow energy rallies when you come on the show. I don't know how you do it, but you did it again today. But having said that, let's talk about the big picture. Obviously, this is a challenging stretch, an interesting week with a lot of indicators getting really negative very quickly. Talk us through your first chart, what it's telling you about this environment.
So the the one point, this is the NASDAQ 100 bullish percent index in the middle panel. At the top is the NASDAQ 100, and on the bottom is the percentage of stocks that are above the 200-day moving average. And I think what you'll notice if you just look at 2022, on the lower panel, we're in a space that we haven't been in for 13 years. It's been all the way back to really 2008 before we kind of got down to these lows. So it tells me that we're in a different environment than anything we've seen in the last 10 years. And that is quite concerning. If we go to the middle panel, you can just see that we have chopped up and down more this year than at any time in the last 20. So that's kind of how difficult the market has been to have these wild swings, especially on the bullish percent index, the way they're calculated. It takes a big move to reverse this. So these things are really whipping back and forth, trying to get hold. And up at the top, of course, we're sitting right on that huge trend line. I've been ignoring the 2020 low because it really came and went, not so much as an investor's behavior. I mean, it was, but then we had the Fed and every central bank kind of throw money at it so quick because they didn't want to lose votes or something. But anyway, that trend line has held for 12 years and we sit on it today. So it makes for a pretty compelling place for us to make sure this holds, I think.
It's a really interesting chart. That bottom one, looking at it's scary to look at the similarities between where we're at now in 2008, obviously, where we had further downside. The second one is some similar charts, but with the S&P 500. What does this tell you? Anything different?
Yeah, this one doesn't. This one, the bigger thing is as a group, we've been able to break below this level before, not very often, only in 2020, but the whole market went down, not just, and technology actually held that 2020 low a little bit better. But what I think is critical here is we're sitting down at the lowest level on this. If we just ignore that COVID, it was either 2002 or 2009. Do you really kind of want to bet against that? And that's a pretty hard place to be. If you look at the way I've drawn the trend line up on the top panel, we have broken that trend line. Now, again, where you place the trend line, I think we could all debate which trend line is more valuable, but this one has at least 6 touches, which makes me comfortable that it's a pretty strong place. And so I would just say that trend line breaking gives me very little comfort. And then in the middle panel, you can see that we've actually stretched twice to the bottom level, and we did this on the NASDAQ one above, but that tells us that so many stocks out of, I'll call it a very wide, broad spectrum of the US economy, is sitting on that lower level. We don't reach twice in a year very often. And unfortunately, the last kind of time we spiked down to these levels twice was 08, 09. So we're in high water here. We're definitely struggling, and it's tumultuous. So I'm looking to see if we can climb out of this, but I'm really thinking this sets up for 2023 as quite a vicious scenario.
Your final chart addressing the bond markets, I mentioned in our market recap, that's obviously a big story in 2022, higher rates in an attempt to address inflation. What is this chart telling you about the interest rate environment?
There's 2 vertical red dotted lines in the middle of the chart in 2000 and 2008. And it was really once the inverted yield curve actually started to normalize and they got back above the 40-week or the 200-day moving average. And when they got back above, that's actually when the bear market really started in 2000 and 2007. So not that I want to be the bearer of bad news. I kind of think 25% has been a long haul already. But that chart basically, just because the yields start to normalize doesn't mean that we're out of the woods. And I think whether you use this one, this is the 30 minus the 10s, but take any of the spreads, plot them, and just go see if you have any comfort with them. They all give me a little bit of shock value.
Yeah, earlier this year, you got different readings at times from different parts of the yield curve. Now it all looks very, very similar in a similar conclusion to what you mentioned there. So, Greg, if we are in this position of weakness, if this tells us about potential for the market to still, have challenges, where do you look for opportunity in this sort of environment? Where are you finding places to be, or is it just get away, get defensive, and ride this out? How are you approaching things?
Well, I've been way more defensive, but I like oil a lot more at 75 than I did at 130. And I like copper a lot more at 330 than I did at $5. So again, Greg, back to basic materials and energy, but that Devon chart is still making higher highs. The XLE, holding the 200-day, really, I want to just make sure that they hold. And there's a whole bunch of issues, and I'll be covering some of those off at ChartCon, actually. So I'm looking forward to sharing a bunch of charts probably you haven't seen before. But the big theme I want to keep in mind here is we're going through a massive energy transition and an energy crisis at the same time. And I think there's a huge opportunity for us in those spaces.
This has been awesome, Greg. As always, appreciate you sharing a couple charts. Cannot wait to see you in Redmond next week. So travel safe, and we'll see you here soon. All right.
Look forward to it. Thanks, Dave.
That's Greg Schnell. Greg is the chief technical strategist and the founder of Osprey Strategic, coming to us from the Calgary area. And I love that. My conversations with Greg have always been so interesting. He likes to talk about the big picture, but also focus a lot of times on energy, raw materials, basic materials, and how they relate to the fundamental thesis. My conversation with Mark Chaikin earlier this week was talking about that interplay between the fundamentals and the technicals. That's what a lot of the conversations I have with Greg really get to, thinking about supply issues in the oil space and what that relates to, how that relates to oil prices, how that relates to energy stocks. So that is another area of the market that Greg will be covering as part of ChartCon. Should be a ton of fun. Let's continue on our show today with our next segment, Getting Sentimental. I hinted earlier we had a pretty negative reading on one of the sentiment indicators. We're going to get to that in a minute. We're going to start with the VIX. So we like to do with Getting Sentimental is hit on kind of three areas. We'll start with volatility. We'll look at the VIX. We'll then get into survey data. We'll look at the AAII survey and the name exposure index, also the RIDEX flows, all of them showing some pretty interesting, very bearish readings. Then we'll get to the put call ratios as well. Again, going back to the options market, looking at some positioning data. So, with the VIX, and I will tell you that this is one of the challenges of technical analysis among any financial analysis. It is very easy when a particular signal begins to get really excited and to try to anticipate it, right? Anticipating the indicators. This is something I studied with some of my analysts at Fidelity. We talked about just this, we're so anxious to get a particular signal. A lot of times we almost want the chart we try to almost mentally force the chart to do a certain thing to validate a preconceived notion. It really is one of a perfect example, I would argue, of confirmation bias as reflected in your process. So when the VIX gets above 30, I had a number of people saying, all right, that's the bottom, right? Because the VIX got above 30. And the answer is maybe, right? Look back here in early March, late February. The VIX first got above 30, pulled back, and then went up even further. And that's when the market kind of continued lower. That's when we eventually got to the February low and then the March low, which was lower on a closing basis. So the fact that we've gotten above 30 is not a super bullish sign for me yet. It tells me to start looking for the conditions of the market bottoming out. The risk to that thesis is that when the VIX gets 30, there's no reason why theoretically the VIX couldn't go to 40 or 50 or 70 or something crazy if we would have a completely bombed out bearish phase. I don't know if necessarily that is what I'm expecting. But my point is, just because the VIX has gotten to a certain level, remember, it can go much higher. When the VIX got down to 20, my comment was, it's probably where we'd see a top. But remember, the VIX can go down to 15 or even 10, which it's done in the last couple of years. So the VIX is above 30 so far in 2022. That has been the beginning of the bottoming process in these previous phases. We'll see if this follows the 2022 playbook as cleanly as some of these other areas. But remember, it can actually get above there and stay above there for quite some time. That's what happened here in April and May. We went down another 4 to 6 weeks before the eventual bottom was in place. This is a really interesting chart to share with you, and this is the AAII survey, the American Association of Individual Investors. As of today, the bulls actually increased, which I don't quite understand, but what's interesting is this survey actually prints on Thursday, which means that bounce yesterday probably has reflected a little bit an increase in bullishness. The bears remain almost the same, just above 60%. And here's the reality. If you look back over time, the spread between the two is about 40.8, 40.9%. At that reading, that is the 10th widest spread where bears outnumber bulls in the history of the data series. Go back to 1987. This is the top 10 weeks. Going back how many weeks, right? Going back to 1987. This is the top 10, the 10th biggest spread. The number 4th biggest spread was last week, right? Which is just a little bit more than this current one. And if like you can see other times going back historically, 2 others were in 2022 in June, and then in April we got below this level. The only other times we got this wide of a spread between bears versus bulls was a couple times in 2008, 2009, notably in January 08, in March of 08, which were similar levels to what we saw right now. So much earlier in the downtrend, and then going back all the way to 1990, or the other times when you saw really significant spreads between the two. By the way, you also have 60% bears, which is one of the highest levels that we've seen. The highest level ever, by the way, was in March of 2009. It got up to over 70%. But again, when it's this point, it's sort of a top 10 level. The highest one, I think this is the sixth highest level of bearishness in history at just over 60%. So having said that, right, sentiment is very negative. But what we saw certainly from April and from June is just because the sentiment is very bearish doesn't mean that is a big cyclical market bottom. I think that's where people are trying to anticipate the reversal a little earlier than the evidence might suggest. All you need to do is go back to 2008, 2009, look at this chart and see what actually happened to sentiment. You had incredibly negative readings, not at the end, but before the end, well before the eventual low in March of 09, you had a lot of negative readings as well. That came up earlier in my discussion there with Greg Schnell looking at breadth data, and that's my concern for this market. Speaking of incredibly negative readings, the name exposure index is down to below 13%. Going back for the last 7 years, that has only happened one other time, and that's in March of 2020 when we got just to almost 10%. This rating is literally one of the lowest ratings we've had. This exposure index does go negative very rarely, but it has done that. I think back in 08, 09, it actually went below zero, and other times as well. I haven't done a deep dive on this one like I did with the AAII survey earlier today, but it's worth noting for most of 2022, money managers in this survey have been underweight equities. The average for this data series is around 70%. We're currently down for most of the year. We've been well below that. And recently, we've been extremely below that, right? With an average around 30% for the last month. Today, we're getting down to the teens. We're very close to going negative, which we have not seen for over 10 years, if I remember right. On the bottom, we have the Ridex flows, and this is plotted inversely to sort of match the general positioning. We were very bullishly positioned in the Ridex family in December. We were very negatively positioned. The only times we've been lower than this, besides 2022, were in the March 2020 low, and then in 19 as well. Note back in 2015, 2016, we're well below these levels. And again, that's the concern with some of these levels. Just because we've seen the lowest levels in the last couple of years doesn't mean in deeper bear market phases, we can't go much, much lower. Folks, that is a wrap for the show. We go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I was inspired looking at Greg Schnell's charts. He shared those earlier today, and I was looking at some of his trend lines. And I thought, I'm going to draw some trend lines, just thinking about the long-term analysis. I did this trend line analysis looking at this closing data for the S&P, weekly data. I'm looking at the March 09 low. I'm looking at the March 2020 low. I'm connecting those 2 points with a trend line. That gives us a downside objective if we would continue at a similar pace, sort of in that 3,200 to 3,300 region. I am fascinated by the fact that this trend line on the log scale chart lines up mysteriously well with the Fibonacci analysis we've been talking about recently, talking about 3,200 as the 61.8% retracement of this move from March 2020 to January of 2022. So maybe 3,200 ends up being the eventual low. I'm not sure, but that's certainly a trend line I am watching right now. Chart number 2, Devon Energy. As I mentioned, my guest today, Greg Schnell, always does a great job highlighting some of the factors related to the energy market, but looking at it through the lens of technical analysis. I think that's so fascinating and really a well-defined investment process that he likes to follow. I'm struck by how charts like DVN are rallying this week as the week goes on, as the average stock is struggling, up 1.5% while the market's down 2% using the S&P, coming out of the oversold region. Can it hold that 200-day moving average? So far doing so okay. Finally, gold. Boy, we have so not talked about gold often, and anytime I've brought it up, I've just said it's still going down. We'll talk about it when it stops going down. So I have to highlight, this is one of the areas of the market they're actually bouncing higher yesterday and today. Yesterday, all the risk assets were up. Today, all the risk assets appear to be down. Gold is somehow managing to have a nice update on both of those, closing well above the open in both cases. Is it too early to declare this some sort of reversal? I would argue 100% yes. And you can see that by the fact that the RSI still remains very firmly in a bearish phase. Get excited when gold actually breaks out of resistance, when it makes a higher low. That's something we've not really seen yet, but that's why gold might be on, should be on your radar, and it certainly is on mine to see how that evolves. This green shaded area, by the way, 158 would be a great place for the GLD to break above. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Sign up for ChartCon today. Go to stockcharts.com/ChartCon. All of our previous episodes and interviews are at stockchartstv.com. I'm Dave Keller for stockcharts.com. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.